You drive past it every single day. You don't even see it anymore. It's just noise. A steel pole with a mattress, ad, or a personal injury lawyer's face 30 feet above the highway. Now look at the building behind it. Nice. A restaurant, real tenants, real square footage. That building probably took years to build and millions of dollars in financing. Here's the number that breaks your brain. In the right location, that ignored steel pole can be worth more than the building standing right behind it. Not because of the sign, not because of the steel, because of one word printed on a piece of paper you'll never see. A permit. And that one word is the entire reason this industry generates billions of dollars a year off.
Of objects you've trained yourself to stop looking at.
Outdoor advertising isn't one business. It's 4 completely different businesses wearing the same steel skeleton. And the gap between the bottom tier and the top tier is the difference between a side hustle and a Wall Street asset class. Tier 1. The Rural Static Bulletin. This is the classic county road billboard. 2-lane highway, maybe a farm supply ad, maybe a personal injury lawyer. Structure cost to be built, somewhere between $15,000 and $25,000. Land lease to the farmer or landowner underneath it, $300 to $800 a month. Monthly ad revenue on a board like this, often just $300 to $1,200. This tier barely clears its own costs. It survives on volume and curse, owning 50 of these instead of one printcast, and on the fact that once it's built, it basically runs itself for a decade. Tier 2, the Commercial Highway Bulletin. This is the standard 14 by 48 foot board you see on interstates near cities. The ones advertising casinos, injury attorneys, and regional fast food chains. Structure cost? $30,000 to $60,000 depending on height and steel requirements. Land lease jumps to $1,500 to $4,000 a month for high traffic exposure. But now, monthly revenue climbs to $20,000 for a single static face. This is the workhorse tier. It's where most mid-sized outdoor advertising companies make their bread and butter. Tier 3. The Digital Billboard. This is where the math stops looking like real estate and starts looking like a media company. Structure cost jumps dramatically. A full LED digital billboard build-out runs $200,000 to $450,000, sometimes more depending on resolution and size. Land lease climbs too, often $3,000 to $8,000 a month in a solid metro corridor, plus an electricity bill that didn't exist before usually $300 to $600 a month just to keep the panel lit. But monthly revenue on a well-placed digital board can hit $8,000 to $20,000. And we'll get into exactly why in a minute, because that number isn't coming from one advertiser, it's coming from several. Tier 4, the Mega Structure Spectacular. This is Times Square. This is the Vegas Strip. This is the wraparound LED tower in downtown Tokyo, or the digital canyon walls in Piccadilly Circus. These aren't billboards anymore, they're architecture, custom LED build-outs.
For a spectacular tier display can run anywhere from $2 million to $10 million, depending on scale and curvature. Annual lease payments for
the air rights and wall space alone can hit $1 million to $2.5 million a year. And in exchange, the top-tier spectaculars in Times Square generate anywhere from $3 million to over $10 million a year in advertising revenue for a single structure. Same industry, same basic concept: steel, a screen, an ad. But Tier 1 and Tier 4 aren't in the same universe financially. One is a side income stream for a rancher with a highway frontage. The other is a corporate media asset that trades on public exchanges. Now here's the uncomfortable truth about where most first-time buyers land. They think they're buying into Tier 3 or 4, the glossy digital dream. What they can actually afford, realistically, without institutional capital, is Tier 1 or 2. And Tier 1 and 2 have a completely different, much less forgiving cost structure. Which brings us to the part of this video where the spreadsheet stops being fun. Let's build one from scratch. Not the dream version, the real one. You've found your spot, Pume? Decent traffic count, visible from the highway, zoned correctly. Great. Now the bills start. Land acquisition or lease. Almost nobody who owns billboards owns the land underneath them. You're leasing it, typically on a 10 to 20-year ground lease with renewal options. And that lease usually escalates 2 to 4% a year. Miss a renewal negotiation and your landlord can double your rent overnight. Because, remember, permit itself. This is the part nobody budgets for correctly. In many jurisdictions, getting a new billboard permit approved, assuming that specific patch of ground with that specific permit attached to it, is now scarce. You don't have leverage. They do. The approval process with the local planning board. Buying an existing permit attached to an existing structure often costs more than building new and can even find a legal, ungranted location, involves zoning variances, environmental review, spacing requirements from other signage, and sometimes a multi-year construction, purely because of the years of red tape it saves you. Structural engineering and construction. For a standard highway bulletin, you're looking at $30,000 to $60,000 in materials and labor. But that number assumes normal soil conditions and normal wind load requirements. Build near the coast, Florida, the Gulf Coast, the Carolinas, Pote, and your structural engineering has to account for hurricane-force wind loads, which can push construction costs up by 30 to 50%. Insurance. This is the line item that quietly kills margins. Billboards are, structurally, giant sails bolted into the ground. Wind is not your friend. In hurricane and tornado corridors, specialized structural liability and wind damage insurance policies in that region altogether, forcing operators into expensive surplus lines coverage. Electrical permitting for digital. If you're building a digital board, can run several $1,000s a year per structure for EV, and after a major storm event, some insurers simply stop writing new. Plus local electrical permitting and inspection fees that can run into the tens of thousands of dollars before the sign ever turned total. You're not just paying for the LED panel. You're paying for a dedicated electrical service upgrade, often requiring its own utility transformer. Maintenance cars. And this is the one everyone underestimates. A static vinyl billboard needs its face changed every time a client's campaign rotates, typically every 4 to 8 weeks for a high turnover board. Each vinyl change costs $800 to $1,500 in labor. Maintenance cars. And this is the one everyone underestimates. A static vinyl billboard needs its face changed every time a client's changeout costs alone, just to keep the thing looking current. Digital boards dodge the vinyl change cost. That's part of their appeal. Materials and lift truck rental. Run the math on a board that turns over campaigns monthly. That's up to $18,000 a year in. Panel replacement on an aging digital board can run $50,000 to $100,000, and most operators are budgeting a panel refresh every 7 years. But they trade it for a different maintenance nightmare. LED panels degrade, individual diodes burn out and need replacement modules. A full appraised value might get taxed considerably higher than static ones. In some jurisdictions, converting a static board to digital can triple its to 10 years. Property taxes. Billboards are assessed as commercial structures in most counties, and digital billboards plumb because of their higher assessed property tax overnight and regulatory compliance. Local governments routinely revisit sign ordinances, brightness caps for digital boards, dimming requirements at night, minimum spacing from residential zones, restrictions near school zones. All of it can change after your board is already built, sometimes forcing expensive retrofits or, in the worst cases, forced removal with minimal compensation. Added up, a single Tier 2 commercial bulletin, done properly, with real insurance and real compliance, isn't a $30,000 side project. By the time you account for land improvements, permitting, insurance reserves, and a maintenance sinking fund, you're realistically all in for $65,000 to $90,000 before the board generates a single dollar of ad revenue. Now here's where the mental model breaks down a second time. Everything I just listed is what it costs to keep one ad running on that board. And for most of this industry's history, that's exactly how it worked. OTUDs. One advertiser, one board, one monthly check. Which is a fine business. It's not a great one. The great business only shows up once you understand what happened when this industry went digital. Here's the sentence that explains the entire modern outdoor advertising industry. A static billboard sells space. A digital billboard sells time. That distinction is worth billions of dollars, and almost nobody outside the industry understands it. When a board is static, vinyl, printed, physically bolted to the frame, it can only ever have one advertiser on it at a time. One company pays the monthly rate. That's the entire revenue ceiling. If the location generates $4,000 a month in demand, you can only ever collect $4,000 a month because there's only one printed face and one client. Now convert that exact same pole, same permit, same land lease into a digital LED screen. Suddenly, that one physical asset can display rotating advertisements, typically 8-second spots cycling through a loop of 6 to 10 different advertisers throughout the day. Read that again. One pole, one permit, one land lease, one electricity bill. And now, instead of one tenant, you have 8. This is the exact same trick as an apartment building converting from single-family rentals to a micro-unit co-living model. The physical footprint doesn't change. The fixed costs barely move. but the revenue potential multiplies almost linearly with the number of slots you can sell.
Inside that same footprint. Let's run the actual math, because this is where it gets uncomfortable for anyone who hasn't thought about
it this way before. Say a static board in a good metro location commands $4,500 a month from a single advertiser. Convert it to digital. Now you're selling 8 rotating slots throughout the day instead of 1. You won't get $4,500 times 8 please. The demand isn't infinite, and smaller local advertisers will pay less than the anchor tenant would have. But a realistic blended rate across
those 8 slots might land each one somewhere between $1,200 and $2,000 a month. 8 slots at an average of $1,500 each is $12,000 a month. Compare that to the $4,500 a month you were making as a static board. That's nearly a 3x
revenue increase Cove on the exact same pole, exact same permit, exact same land lease. Your fixed costs barely moved. Land lease,
insurance, and property taxes are roughly the same, maybe slightly higher for the digital assessment. Your only real new expense is electricity.
A few $100s a month, and the amortized cost of that $200,000 to $450,000 LED panel itself. This is why every major outdoor advertising company on Earth has spent the last 15 years racing to convert their static inventory to digital as fast as regulators will allow them to. It's not about the technology being flashy. It's about turning a single-tenant asset into a multi-tenant one without adding a single square foot of new real estate. There's a second layer to this profit engine that's even less visible. Dynamic and programmatic pricing. A static billboard has one price, set months in advance, regardless of what's actually happening in the
world. A digital billboard can change its rate plume and its content pelvis in real time. Rush hour on a Friday before
a holiday weekend? Premium pricing. A local sports team just won a championship? Sell that slot to a celebratory local sponsor ad. The markup. Sold same day through programmatic ad platforms the same way websites sell banner ads. This turns a billboard from a fixed lease asset into something closer to a yield-managed hotel room. A business model most people associate with airlines and Marriott, not steel. Poles on the interstate. You're not renting space anymore. You're managing inventory in real time to extract the maximum price for the market will bear at any given hour. This is also, quietly, why the largest players in this industry structure themselves as REITs real estate investment trusts, rather than traditional media companies. Lamar Advertising operates as a REIT specifically because its underlying assets behave like real estate. Fixed locations, long-term land leases, appreciating scarcity value, and predictable cash flow once stabilized. But its revenue engine behaves like a media company. Dynamic pricing, rotating content, programmatic sales. It's a business that gets the tax advantages of real estate and the margin profile of advertising. That combination is exactly why operating margins in this industry regularly clear 30%, a number most traditional commercial real estate operators would consider fantasy. So here's the actual profit hierarchy of this industry. Top to bottom. Bottom, static rural boards, single tenant, thin margins, mostly a cash flow hobby. In the middle, static commercial bulletins in decent corridors, better margins, but still capped by the one-tenant ceiling. At the top, digital boards multiplying tenants across the same footprint, layered with real-time pricing that extracts maximum value hour by hour. The building behind the billboard might be worth more on paper, but it has one tenant, fixed rent, and years of vacancy risk. The billboard in front of it can have 8 tenants by lunchtime and adjust its price before dinner. That's the inversion. That's why the sign is sometimes worth more than the building it's advertising in front of. Now for the part where this all falls apart. Because it does, regularly, and it's almost never the advertising business itself that kills these companies. It's the debt. Outdoor advertising has one of the most stable, predictable cash flow profiles in commercial media. Once a billboard portfolio is built and permitted, occupancy tends to stay high and churn is low because advertisers value continuity, bro. A brand doesn't want to lose its spot on a high-traffic corridor to a competitor. That stability makes billboard companies extremely attractive to lenders and private equity. And that attractiveness is exactly what destroys them. The single most important case study in this entire industry is what happened to Clear Channel Communications in 2008.
In 2006, a private equity consortium took Clear Channel Communications lease, which is at the time owned both a massive radio network and one of the largest outdoor advertising businesses in the world. Through it,
Clear Channel Outdoor division so private in a leveraged buyout worth approximately $24 billion. The deal closed in 2008, right as the global financial crisis hit, and it was financed with an enormous amount of debt loaded directly onto the company's own balance sheet.
Here's the mechanism, because it's important to understand structurally, not just as a headline. In a leveraged buyout, the acquiring firm doesn't primarily use its own cash to buy the company. It borrows against the target company's future cash flows and assets, and then
Saddles the acquired company itself with that debt. The billboards didn't get more valuable. The land leases didn't get cheaper. But the corporate entity that owned them now had to service billions of dollars in new debt payments every single year. On top of the normal operating expenses we just walked through: land, insurance, maintenance, permitting. For over a decade, both Clear Channel Communications Chrome,
later rebranded iHeartMedia for its radio operations Cobalt, and Clear Channel Outdoor operated under the weight of that debt structure. The underlying billboard business kept generating solid, predictable cash flow, the way outdoor advertising almost always does. But that cash flow was being consumed by interest payments on a leveraged buyout from over a decade earlier, rather than being reinvested into digital conversions, new permits, or the
paying down principal. By 2018, the radio side of the business, iHeartMedia, filed for Chapter 11 bankruptcy, restructuring roughly $20
billion in debt. The outdoor advertising division was eventually separated into its own standalone public company, Clear Channel Outdoor Holdings, in 2019.
But it inherited a significant chunk of that debt burden, and has operated for years since as one of the most heavily leveraged public companies in the media sector, with total debt that has hovered in the range of $5 billion against a business whose annual revenue, even in strong years, sits well below that figure. The lesson here has nothing to do with billboards being a bad business. The billboard economics we just walked through are genuinely strong. High margins, scarce permits, low churn.
The lesson is that a great cash-flowing asset, purchased with someone else's borrowed money and structured to extract maximum leverage, can be turned into a financial liability regardless of how good the underlying operations are. The company wasn't killed by advertisers not buying billboard space. It was killed by a balance sheet built during a different decade for a different set of interest rates that never got restructured in time. Compare that to Lamar Advertising, which took a fundamentally different approach, funding growth through operating cash flow and disciplined acquisitions rather than an aggressive leveraged buyout, and structuring itself as a REIT specifically to align its capital structure with
the stability of its underlying assets. Same industry, same permits, same digital conversion playbook, wildly different debt discipline, and the difference shows up directly in the stock performance and credit ratings of the two companies over the past 15 years. There's a smaller scale version of this failure that happens constantly at the individual operator level, and it's worth mentioning because it's the version most viewers of this video would actually encounter. Independent billboard operators frequently over-leverage to fund a digital conversion, taking out a loan to cover that $200,000 to $450,000 LED panel cost, betting on the revenue multiplier we discussed in the last section. When it works, it's transformative. When local ad demand doesn't materialize as projected, a recession hits, a major local advertiser pulls out, a competing digital board goes up half a mile away and splits the market date there. That operator is left servicing a 5- or 6-figure equipment loan against
revenue that never scaled the way the pitch deck promised. The pattern is always the same. Whether it's a $24 billion leveraged
buyout or a single independent operator with 3 boards. Debt doesn't care about your margins. It cares about your payment schedule. And billboard economics, as strong as they are, don't protect you from a repayment schedule built on overly optimistic assumptions. So let's land the plane. What does this business actually return once you strip away the fantasy? The optimistic scenario. You own a well-located digital billboard in a solid metro corridor. All-in build cost, including land improvements, permitting, and electrical work. Call it $350,000. Monthly revenue from 8 rotating advertisers, blended at strong occupancy, $12,000 or $144,000 annually. Subtract land, roughly $50 to $60 a year in a well-run operation. Net operating income lands around $85,000 to $95,000 a year.
On their
A $350,000 investment, that's a 24 to 27% annual return before financing costs. That is genuinely an exceptional return for a real
estate-adjacent asset, and it's exactly why institutional money has piled into this sector. The realistic scenario looks nothing like that. On a digital board isn't 8 advertisers running at premium blended rates every single month. It's fluctuating demand, seasonal soft spots, and a meaningful chunk of unsold inventory that gets filled with house ads or discounted rates just to avoid a dark screen. Realistic annual revenue lands closer to 90 to 100,000 rather than 144,000. Realistic OPEX runs higher than budgeted because it always does.
An unexpected panel repair here, a land lease escalation there, an insurance premium spike after a regional storm season. Net operating
income in a realistic year lands somewhere between $30,000 and $45,000. On that same $350,000 build cost, that's an 8 to 13%
return plib. Solid, comparable to a decent rental property, but nowhere near the fantasy number the industry markets itself with.
And if that build was financed rather than paid in cash, which it almost always is for an independent operator, debt service can eat a significant chunk of that realistic scenario profit before you ever see a dollar. Here's the rule this entire industry runs on, and it applies whether you're evaluating a single roadside bulletin or a multi-billion-dollar outdoor media conglomerate. The permit gives you the right to print money. It does not guarantee you'll actually print it. The scarcity is real. The margins, when it works, are genuinely some of the best in commercial real estate. But between the permit and the profit sits a gauntlet of land leases
that escalate, insurance that spikes after every storm season, maintenance schedules that never fully go away, and most dangerously, debt
structures that can turn a stable cash-flowing asset into a corporate liability for over a decade. The billboard you ignored on your drive this morning isn't just an ad. It's a scarce, permitted, multi-tenant cash flow machine sitting on top of a balance sheet you can't see from the highway. Some of those balance sheets are printing money quietly, year after year, exactly the way the pitchins promised. And some of them are one refinancing away from bankruptcy court. From the road,
They look exactly the same.